What's up, guys? Back for the third video today, and I'm going to get back into part two of managing financial institutions or managing banks. So we're going to go over four things, make this video pretty short and sweet. So bank management principles about managing banks. There are four principles for you to understand. Liquidity management, asset management, which means managing credit and interest rate risk as well. Liability management, and the fourth thing is managing capital adequacy. So let's get into that. So obviously we're going to start off with liquidity management and just making sure everything's liquid, that cash is readily available. But let me go ahead and kind of roll it around a little bit because I want to not go in order. I want to put things in how they're managed from pretty much least to greatest or greatest to least, depending on the severity. But I'm going to start off with asset management. So, asset management for a bank. Attempt to create the highest possible return on assets. Remember what the assets are. The return on assets while minimizing risk. Now, obviously, whenever, not even just a bank, but whenever you're in finance, whenever you're doing things in life, you want to have the best return on anything that you invest in or you have while minimizing the risk. Because if you have higher risk, yeah, higher reward, but everybody wants things to be simple. They want high returns with minimal risk because it's just efficient. So, how do banks do that? So, they get borrowers with low default risk. Because, like I said, when loans are their assets, you got to understand you don't want to have somebody default on their loan. You don't have somebody say, I took out a loan and now I can't pay it back. So, they get borrowers with low default risk, but they pay high interest rates. That's where the bank gets in. That's the kicker. Because when banks see, okay, they're good on paying back credit, aka they're good on paying back their loans, so their credit score is going up. So we trust them enough to have low default risk. So therefore, we'll give you this loan that's more than the person that has a lower credit score than you, but you're going to pay higher interest rates. Why? Because we know you're going to pay us back. That's just how a bank works. Now, is that bad on some terms or moral sense? Well, maybe it could be, but at the same time, this is the money industry, so banks know what they're doing. So I will say props to banks for doing that. Not saying to steal from people, not to rob from people per se, but at the same time, if you're gonna pay that on a loan, then banks got you. So they get the borrowers the lowest default risk to pay high interest rates because, like I said, they make money on top of money. That interest is the money paid on top of the principal from that loan. They buy securities with high return, low risk. So you're probably thinking high return, low risk. If you go back to my securities common stock videos, you can understand a little bit more. But let's just say that banks are very efficient on things. They're not going to dive into something that's going to take out their whole entire cash spread. They're going to say, let's go ahead and buy securities that give us a good return but low risk. Maybe not the best, but it's higher than average or it's higher than usual things that have higher risk. Because like I said, high risk, high reward, low risk, low reward. Sometimes you could go low risk, high reward, or high risk, low reward. It just depends on the market, depends on the volatility, it depends on the status of the market at the time. And they diversify for asset management. Banks don't just put their money into one thing or put their assets into one item. They do it in multiple things because that's why you have cash, you have loans. That's why banks do things for their assets with securities and other assets, reserves, because they don't need to say, let's just do it securities. That's one thing. What if the securities don't work out? You don't have anything else. So they put in securities, loans, the cash and the cash reserves, and other assets. Now, we're going to go into liability management. So managing their source of funds, certificates of deposits, or other debt. They use the ALM committee, which is basically senior management for understanding banks' liquidity and their interest rate risk. And they help out by giving risk management, etc. So just to make it simple, the ALM committee helps banks manage their debt and their interest and etc. Things that are crucial to their liabilities. So they identify deposit patterns and forecast them. Because look, when you have those checkable deposits as a pattern, you understand when people are putting their money in, so you can account for that. Or whenever you can forecast things, when you can say, hey, this is how our debt's going to look in the future if we incur a project. This is how our debt's going to look in the future if more people make this type of deposit. Because when you identify patterns, you can learn how to leverage yourself. You can learn how to learn and evaluate things as a bank. Not just going for banking, but this also helps for real world when you're owning a business or when you're managing a business. Because you can understand where you need to go in terms of liabilities. Obviously, bank liabilities may differ from business liabilities, but think of it big picture. Think of it high level. When you can identify identify a pattern and understand the forecasting, when you can say, if I roll it 90 days forward, this may be pretty precise or approximate to what may happen in the future, barring any other circumstances. But when you account for those circumstances, you can understand how to manage your liabilities. Because yes, banks want to have the highest return on their assets while minimizing risk. But when it comes to liabilities, they also want to understand, hey, how are we managing our debts? How are we managing source of funds? Because we too have to pay for things. So banks don't want to hold a lot of capital. Now remember, bank capital is a liability. So obviously they don't want to hold a lot of capital, because the higher the bank capital, the higher the people invest in you, the lower the return on equity, because people obviously are going to want a return on their money for themselves, not necessarily for you. So let's go in to talk about some profitability. Well, excuse me, not profitability. Talk about ratios. I'm jumping ahead of the gun. So return on assets, your net profits divided by your assets. So obviously you want a high ROA with the lowest risk, as I said, for asset management. Your return on equity, your net profits divided by equity capital. Now, obviously, like I said, the owners are going to want their highest return for them first, and then comes the bank. Because when you're investing into something, of course, you want the company to do good for you, but you want the highest return. Then you say, okay, the company gets their return, but it's your money. That's why it's a liability to the bank, because they're making money for other people, because people invest in them. Just like if somebody invests in you, they want something out of you. Obviously, you want something out of yourself, but they also want a piece of the pie. So just remember, high ROA and high ROE is good for the bank, because they have a return on assets, return on equity, because they're returning and getting more money off of things that they invest in or having money put into them. Now, as capital increases, equity multiplier goes down, your return on equity goes down. So if a bank manager, if they feel that it's too much capital that's being held, they're going to sell, retire stock, increase dividends, or increase asset growth via CDs, so debt. And you're saying, well, why would there be too much capital? Because if they feel like too much capital is held, they're going to want to just get rid of some of that capital to leverage themselves out. So that way they don't want to have the lower return on equity. So they're probably going to sell the stock, retire the stock, or maybe say, okay, we're going to pay out more dividends so we can get rid of some of that excess, or increase the asset growth. So that way they can have more assets on hand to have a better ROA. Because remember, the main thing is that asset management is having to attempt the highest return, or highest return earned on your ROA while minimizing the risk. So if they feel like too little capital is held, they're going to do the opposite. They might issue stock, slow the asset growth, retire debt, so aka don't lend it anymore. So that means they're not going to lend out any more money, or decrease dividends, because they feel like if there's too little capital held, then we can have really the highest return on our assets. So we're going to go ahead and try to, equity. So obviously, like I said, the higher the capital, the lower the return on equity. So the little the capital, higher return on equity. So you maybe want to slow asset growth, not lend anymore, or decrease dividends. And that's what a bank will do. Now, here are off-sheet activities, maybe off-balance sheet activities. So you have loan sales, which is secondary loan participation. You have fee income from backup lines of credit, which guarantees of debt are also there, and foreign exchange trades. See, these are things that may be done off the balance sheet by banks. And it involves risk and conflict, because A, you have loan sales, loan security participation, or you have fee income from backup lines of credit. Now, obviously, people don't know a lot about that from the basic things of a bank, but foreign exchange trading as well. That is not really shown to people. So trading activities and financial futures, etc., and then interest rate swaps, that's things that are not really held to the forefront of a bank. It's very risky because A, like I said for my previous videos of foreign exchange, you have spot rates, you have future rates. Rates fluctuate all the time by seconds. No rate is going to be the same. So that's why it involves risk and conflict. But if a bank can create arbitrage, a bank can find a way to profit from things with foreign exchange trades, then your bank is probably doing something that they know they're really good at. Because obviously you want a bank that knows what they're doing. You don't want a bank that's not going to know what they're doing. It takes a lot of risk. And in turn, your money's being spent out and you're losing money by being at the bank, because the bank might go insolvent because they don't know how to pay back things, or they gamble a little bit too much. Let's say it like that. But obviously, bank performance looks at income statements, operating income, operating expenses, net operating income. That's what banks look at for their performance. And that is all that we have today. But just remember, part two of managing a bank, you have to understand liquidity management, you have to understand liability management, you have to understand asset management, you have to understand bank adequacy in terms of finance. So just remember, a bank is managed as best as it is by the people that are in there. So whenever you have somebody that knows that what they're doing, then you want to see credibility from your bank, well, bank employees, bank owners. But remember, when you invest in a bank, look at credibility first. See who's on the board, see who knows how to run the bank. Because if you don't have somebody that's credible, your bank might be in the way of being insolvent. So thank you guys for watching. Please tune in for the next video. Appreciate it.